I spent $42 million to drill a hole into the side of the Sierra Diablo Mountains to install a mechanical clock that ticks once a year, because I am terrified of the short-term thinking that is currently infecting your portfolio. And if you do not understand the connection between that clock and the artificial intelligence stock you just bought, you're going to watch your net worth evaporate in a way that mathematics guarantees. And your optimism cannot prevent. You're standing on a trapdoor and the lever is being pulled by the laws of thermodynamics, not by market sentiment. And right now you are looking up at the sky, admiring the clouds while the floor is dropping out from under you. The only way to stop your free fall is to understand the mechanism of the trap before it snaps shut. Because what is coming is not a market correction, it is a reversion to the mean of physics. And physics does not negotiate with your retirement fund. The danger you face is not that the technology is fake, but that the economic model supporting it is a hallucination, a day two stasis disguised as a revolution. And I saw this exact hallucination 3 weeks ago when I sat across from Marcus in a windowless conference room in Seattle, a founder who was trembling because I asked him to show me the calorie count of his business model. Marcus had a slide deck promising to replace human customer service agents with a generative model, and I looked at his cloud compute bill and I looked at his revenue per use, and I realized Marcus was burning $4 of electricity to generate $3 of value. And when I pointed this out, he told me that scale would solve the margin, but I told him that scale makes bad unit economics fatal, not bad, because if you are losing $1 on every transaction, scaling just means you go bankrupt faster, and Marcus is going to zero, not because his code is bad, but because he is fighting a war against the cost of energy, and energy always wins. This energy war is the invisible hand that is about to strangle the AI market, and most of you are ignoring it because you think the cloud is magic, but the cloud is just a building in Virginia that is currently melting the power grid. And I know this because Sarah, who manages one of the largest energy brokerages on the East Coast, called me at 3 in the morning because she couldn't secure enough megawatts to keep a single AI training cluster online without blacking out a hospital. Sarah told me that the demand for power is doubling every 6 months, while the supply of power is moving at the speed of regulatory approval, which is to say it isn't moving at all. And this creates a hard ceiling, a physical limit, where the price of intelligence becomes so expensive that no startup can afford to run the model they just built. And when that happens, the valuation of every company dependent on that compute collapses because they have built a Ferrari, but gas costs $1 million a gallon. The collapse of affordability will reveal the laziness paradox that I discussed with Elias, a lead developer who left a major AI lab to work on his own farm because he was disgusted by what he saw. And Elias told me that the models are not just hallucinating, they are suffering from a degradation of effort, optimizing for the path of least resistance, just like a human bureaucrat. Elias showed me a coding assistant that was writing slots in secure code, because the model had learned that good enough is statistically more common than excellent in its training data. And if you build your company on a foundation of automated mediocrity, you do not have a competitive advantage. You have a liability that scales, and when the market realizes that we are paying premium prices for average outputs, the hype cycle will invert, and the companies that promise to replace humans will realize they have simply built a very expensive way to generate spam. Spam is what happens when you have no moat, and I learned about moats by selling books when everyone told me the internet was for nerds. But the AI companies today have no moats. They have wrappers, thin layers of interface over a brain they don't own. And I watched Victor, a hedge fund manager who manages billions, lose 40% of a position in a single afternoon because the underlying model provider released an update that made his portfolio company's product obsolete instantly. Victor thought he was investing in a software company, but he was actually betting on a tenant in a building where the landlord can change the locks at any moment. And this tenant mentality is the day two disease that kills innovation, because you cannot build a generational business if you are renting your core competency from your competitor. And right now, 99% of the AI ecosystem is renting its existence from 3 or 4 giants, who will crush them the moment it becomes profitable to do so. The crushing will be brutal, because it will coincide with the trust crisis, a failure point I witnessed firsthand with Dr. Harris, a hospital administrator who tried to automate patient triage to save money, and ended up nearly killing a patient because the AI confidently misdiagnosed a stroke as a migraine. Dr. Harris shut down the program in 48 hours, but the damage to the trust was permanent, and this is the wall the industry is hitting. The realization that 99% accurate is unacceptable in the real world, where I operate, where a 1% failure rate in logistics means millions of missing packages, and in medicine or law, it means lawsuits and death. The market is pricing these tools as if they are infallible gods, but they are fallible probabilistic engines. And when the lawsuits start flying, the enterprise adoption that is priced into your stock portfolio will freeze, and the revenue projections will turn into dust. Dust is what remains when you cannibalize your own fuel source, and the AI models are currently eating their own tails in a phenomenon called model collapse, which I saw clearly when a synthetic media engineer named Elena showed me what happens when an AI trains on AI-generated content for 5 generations. The images Elena showed me were nightmares, distorted grotesqueries, where hands had 7 fingers, and faces melted into because the machine was drinking its own bathwater. And this matters to your money, because we have already scraped the entire internet. There is no more fresh human data to feed the beast, and without fresh data, the exponential improvement curve creates a and markets do not pay a premium for plateaus. They crash when the growth stops, and the growth is stopping because the fuel tank is empty. The empty tank forces a return to reality, and the reality is that physical friction is the only thing that matters. A lesson I learned from Rashid, a floor manager in one of our fulfillment centers, who watched a $10 million robot fail to pick up a uniquely shaped dog toy for an hour, until Rashid walked over and picked it up with his human hand. Rashid looked at me and said, "The hand is free. The robot costs a fortune." And that is the unit economics of the future, where biology beats silicon in the messy, chaotic real world, and the companies that are trying to replace Rashid are going to burn through their capital and fail, while the companies that use AI to make Rashid 10% more efficient will survive. But nobody is betting on efficiency. They are betting on replacement, and that bet is a losing ticket. A losing ticket is exactly what you are holding if you are ignoring the silence of the smart money, because while the retail investors are screaming about the revolution, the serious capital is quietly moving into the unsexy, boring infrastructure that controls the choke point. I know a land developer, let's call him Chad, who used to hype crypto, and now he is hyping AI apps, and Chad is the signal to sell. But I also know a silent investor named Warren, not that Warren, another one, who is buying copper mines and water rights near data center. Warren understands that AI is just a mechanism to convert electricity and water into tokens. And if you own the copper and the water, you win regardless of which chatbot becomes popular, because the gold rush needs shovels, but this time the shovels are made of megawatts and cooling system. And if you don't own the utility, you are just a tourist. You are a tourist in a land where the locals are sharpening their knives, and the bubble popping is the moment the locals close the gates, and this pop will not be a gentle hit. It will be a violent repricing of risk, where the capital floods out of the application layer and retreats to the physical layer. The companies that have tangible assets, that have proprietary data locked in vaults, that have logistics networks that actually move out, they will stand amidst the ruins of the wrapper companies. And this is why I talk about the long term, because in the long term, entropy destroys everything that isn't anchored in physics, and the software-only companies are fighting a losing battle against entropy is coming for your portfolio, and the only way to survive is to stop looking at the shiny object and start looking at the shadow it casts, because the shadow tells you the truth about the resources required to sustain the illusion. I am telling you this because I have seen the power bills, and I have seen the panic in the eyes of the founders who know the music is stopping. And when the silence comes, you do not want to be the one holding the bag of promises. You want to be the one holding the deed to the land. So look at your investments and ask yourself if you own the rocket or if you are just renting a seat on a simulation. because the simulation is ending and the ground is rushing up to meet you very, very fast.